This week, we're going to start talking about consumption-based asset pricing. So the last couple weeks, we've been talking about asset pricing from a portfolio choice perspective. Talk about this idea that investors want to diversify their portfolios, which naturally leads to a relationship between risk and return. And specifically, we, in the CAPM setup, don't have to make any assumptions about investors' own preferences. All we said was that people were generally risk averse, and that was enough to get the result. But the portfolio-based approach has a very specific weakness, which is that, well, it kind of ignores the reason why people invest in the first place, right? You don't invest just so you can grow your portfolio and grow your wealth, right? The point of investing is that you're saving money that you hope to spend later on. Ultimately, right, investment only matters because it leads to future consumption. And so this is the difference between the portfolio-based approach and the approach we're going to do this time, which is a consumption-based approach, which takes into account the consumption patterns of the investor. So if we're going to talk about consumption, we need to think about a consumer's preferences. So a consumer's preferences are going to be measured by a utility function. This is a utility function, and the utility function is just going to tell us the level of happiness or satisfaction that an individual has. Now, the properties of the utility function that we're going to use are that the utility is increasing, so the first derivative is positive, and it's concave, so the second derivative is negative. So we're going to end up with a utility function that looks something like this, right? It's going to be increasing and concave. So this is the type of shape that we're looking for. And the reason that we want this sort of shape is because a utility function that's concave is going to exhibit diminishing marginal utility of wealth, right? Having more money is better, but the additional value of having more money is going to diminish the more money that you have. If you're really rich, an additional payoff doesn't help you as much as if you started off with less wealth. So a typical utility function that has the properties that we like is the natural log. So you see that u prime is 1 over x, that's positive. U double prime is minus 1 over x squared, that's going to be negative. So it has the properties that we like, and we know what the graph of the log function looks like. It looks kind of like this, which is exactly the sort of shape that we want. So let's imagine that we had some kind of payoff. It was either going to be 150 or 50 with equal probability. So if I look at this random variable, it's going to have an expected value of 100. 1/2 times 150 plus 1/2 times 50. So we want to think about the difference between two expressions, the utility of the expected value and the expected value of the utility. The utility of the expected value has been saying, if I gave you the average value of x, how happy would you be? And with log utility, that's going to be about 4.605. The expected utility is, well, what is the utility of giving you this random payoff x? So with probability 1/2, you're going to get 150, so 1/2 times log of 150. And with probability 1/2, you're going to get 50. So 1/2 times log of 50. And that's only going to be about 4.461. So if we compare these two numbers, the utility of the expected value with the expected utility, what we can see is that if I have a concave utility function, that implies that this individual is going to be risk averse. If I'm given a gamble that says I either get 50 or 150, I'm going to be worse off if I have this utility function than I would be if you just gave me $100. I would prefer to take the sure thing. And in fact, I would prefer to take less money than to have to face this risk. So if I have a concave utility function, that's naturally going to produce a consumer whose preferences exhibit risk aversion. So whenever I have a concave utility, I have this kind of identity, which is that the expected utility of x is going to be less than or equal to the utility of the expected value. This is going to be true for any concave u. So a concave utility function gives us risk-averse consumers. And we can measure how risk-averse you are by looking at how concave your utility function is. So we said that the concavity of the utility function was defined by the second derivative being negative. So we can define a measure of risk aversion. I have this minus sign here because the second derivative is negative, the first derivative is positive, and this is going to give me the coefficient of absolute risk aversion. So the coefficient of absolute risk aversion is going to tell me my attitude toward risking some amount of wealth. And what you see here is that this formula is going to measure the curvature of the utility function. The more concave it is, the more risk averse I'm going to be. Related to this is the coefficient of relative risk aversion. And this is very similar to the coefficient of absolute risk aversion, except I put a x in front of it. And what this means is rather than measuring my willingness to risk a certain amount of wealth, the coefficient of relative risk aversion is going to measure my willingness to risk a percentage of my total wealth. So it's all well and good to say that you're a risk taker if you're really rich, because making the same bets isn't going to matter as much to you because it's a smaller percentage of your wealth. So the coefficient of relative risk aversion frames the question differently. It's like, well, how willing are you to risk a percentage of your wealth? Right? So both of these kind of approach this question from different angles, right? The coefficient of absolute risk aversion asks, how willing are you to risk a certain amount of money? And the coefficient of relative risk aversion asks, how willing are you to risk a percentage of your wealth? So if we have a concave utility function like this, so it's going to have this downward curving shape. So let's go back to the same bet we had before. You can either get 50, so this would be the utility of 50. You can get 150, and this would be the utility of 150. Okay, so what is the expected utility that you could get? Well, it's going to be halfway between 50 and 150. Or if I can draw a straight line connecting these 2 points, it's going to be here. Here is the expected utility of this bet x. Well, how does the expected utility compare with the utility of the expected value? The expected value is 100, so if I were to ask, how much do you like getting $100? Well, you actually like it quite a bit more. You actually like it quite a bit more than taking the gamble. So the utility of 100 is higher than the expected utility. I would rather get $100 for sure than get whatever payoff this random bet is going to give me. In fact, another thing I can look at is what's called the certainty equivalent. I can say, okay, well, not only do I like getting a sure payoff better than a random payoff, I'm actually willing to take less money in order to do that. So how much less? Well, I can find the value at which the utility of getting this amount of money is equal to the expected utility of getting the random payoff. That's called the certainty equivalent. And what you can see is the certainty equivalent is going to be less than 100. That means I would rather take less money on average than have to face this risk. And this is all because this function is concave. So it's going to have this downward curving shape. And what I can also see is that if I draw another utility function that's more curved, what you can see is that this function is going to exhibit more risk aversion, right? The certainty equivalent for this new utility function, that where I fixed the same values for U50 and U150, but I made it more concave, the certainty equivalent for this new utility is going to be less. So I'm willing to take even more of a loss in order to avoid risk here. So a couple of utility function forms that we like to use. One is constant absolute risk aversion. And this is going to give me an exponential utility function. This alpha is going to be my coefficient of absolute risk aversion. So here I have u prime of x is going to be alpha e to the minus alpha x. U double prime is going to be minus alpha squared times this, which means that if I compute the coefficient of absolute risk aversion, I'm just going to get alpha. So if I have constant absolute risk aversion utility, that means my willingness to bet some amount of money is going to be the same regardless of my wealth level. Another utility functional form that we're going to use a lot is constant relative risk aversion, or CRRA. And this is going to give me a power utility form. So rho here is going to be my coefficient of relative risk aversion. What you can see is that u prime of x is going to be x to the minus rho. U double prime of x is going to be minus rho x to the minus rho minus 1, which means if I compute the coefficient of relative risk aversion, I see that's just going to be rho everywhere. So once again, the higher this coefficient, the more concave my utility function is going to be, the more risk averse I'm going to be, in this case, in terms of relative risk aversion. So the higher that rho is, the less willing I'm going to be to risk a certain percentage of my wealth. So now that we've talked a little bit about the types of utility functions that we're going to use and the properties that they have, now let's think about setting up a consumer's optimization problem. So when we're thinking about an optimization problem that involves investment, well, we have to think about a multi-period model, right? Because you're buying assets now and hoping to receive the payoffs later. So we want to think about a two-period problem. The simplest version is a two-period problem. We'll think about a multi-period problem later on. So C naught is going to be your consumption today. And so we're going to think about your consumption today. And C1 is going to be your consumption in the future. And we're also going to think about your consumption in the future. However, just like we talked about, people exhibit time preference, right? Getting something in the future is not as good as getting it today. So we're going to have this rate of time preference delta. So we're going to multiply the utility in the next period by this delta, and delta is usually going to be less than 1, which means that utility in the future is not worth as much to us as utility today. The important thing to remember here is delta is not the discount factor. That's going to be something we'll look at a little bit later on. And, well, we also know that your consumption in the future is uncertain, because how much you're able to consume in the future depends on how your investments perform. So that's going to have a degree of risk. So we're going to put an expected value on here. So we want to maximize the sum of your utility today plus your expected discounted utility in the future. I know I said delta was not the discount factor, but we'll see how this all plays in later on. Now, let's think about what constraints you have now. Well, if I could just choose C naught and C1 free of any constraints, I would just consume as much as possible, but I'm not allowed to do that. How much I consume today depends on my endowment. So E naught is how much I'm endowed with, how much I start with, minus how much I save. So let's imagine that I have a single asset that has a price of P naught today, and S represents how many shares I want to buy, okay? So every share that I buy, I have to pay P naught. So I have to reduce my consumption today for every share that I buy. But every share that I buy in the future is, every share that I buy is going to increase the consumption that I can have in the future. So C1 is going to depend on my endowment in period 1. So E1 just represents any non-investment related income I have in the future. And then for every share that I buy, I'm going to earn a dividend as well as the future price of the asset. So because we have a 2-period model here, here's a model where you only live for 2 periods. You're going to sell everything after 1 period. So you're going to receive not just a dividend, but also whatever the price of the asset is in period 1. And so we're going to choose the optimal number of shares that's going to maximize your 2-period utility like this, okay? So the fact that we have a risk-averse utility is also going to tell us a little bit something about why people invest in the first place, right? Because what you could do is you could just consume whatever your income was going to be today and in the future, right? Why invest at all? Well, we know that if I have a concave utility, if I'm a risk-averse individual, then I'm thinking about different possible states of the world, right? Maybe I have a high state and a low state. So I have some payoff in the high state and some payoff in the low state. Well, if I'm risk-averse, I want to bring these closer together. If there's some way I can transfer wealth from the high state to the low state, that's going to make me better off, because if I have a concave utility function, I would prefer that the payoffs in the different states of the world were closer together. Well, the same thing is going to be true for balancing your payoffs across time. All right, so let's imagine that your payoff, that your non-investment income today was very high and your non-investment income in the future was very low. So for example, let's imagine that you're working now, but in the future you're going to be retired. Well, if you're making a lot of money now, you don't want to just spend all of that money now and then when you're retired, you're leaving yourself with nothing. For the same reason that you would want to balance your payoffs across different possible states of the world, you're also going to want to balance your consumption across time. Because your utility function is concave, you would want your current and future consumption to be close together. Maybe not exactly identical, but to some degree, you'd want your consumption to smooth over time. You don't want to end up in a situation where it's either feast or famine. You want more of a stable consumption path. And so you're going to be willing to sacrifice some consumptions in the years in which you know your income will be high, and in order to gain something in the years where you expect your income to be low. Right? So this is the reason why people invest. So we have this consumption smoothing effect as well. So we have this optimization problem. Let's try and solve it. So we want to maximize this whole thing with respect to S. Now we could set up a Lagrangian, but we don't really need to. All we need to do is substitute for C0 and C1 in here and here. So the first order condition is going to be that U prime of C0 times dC0 ds, so that's minus p naught, plus, and I can take the derivative inside the expectation here, plus the expected value of delta u prime of c1 times dc1 ds, which is p1 plus d1, all that is going to equal 0. So I can move this term over to the left-hand side, which is going to give me u prime of c naught times p naught is equal to expected value delta u prime of c1 times p1 plus d1. And I can then divide through by u prime of c naught and get that the price of the asset today is going to equal the expected value delta times u prime of c1 over u prime of c naught times the future payoff. Okay, so if you remember, when we started talking about stock pricing, we had this equation, P naught was equal to P1 plus D1 over 1 plus R. So the price of an asset today is equal to the future payoff discounted at the proper rate. We have the same kind of intuition here, right? The price today is equal to the future payoff, but the discount factor is going to be this whole thing. So we're going to define the stochastic discount factor as delta times u prime of c1 over u prime of c naught. So it's the rate of time preference multiplied by the ratio of marginal utilities. So this is called the stochastic discount factor because M is going to represent how much I value payoffs in each possible state of the world. What you can see here is that M is a random variable because M depends on my future consumption. My future consumption depends on the performance of my investments, and how well my investments perform is going to indicate to me how much I value consumption in each of those future states. So how does the performance of my investments tell me how much I value payoffs in those states? Well, we see that u prime of c naught is in the numerator here, and because we have u, which is concave, what does that mean? The more that I consume in the future, the less I care about future consumption, which means that I'm going to discount payoffs in those states by more. So M is going to be higher in states where my future consumption is low and lower in states where my future consumption is high. What does that mean? That means that when I'm applying this principle to asset pricing, assets that pay well when my consumption is going to be low are more valuable to me, right? I would rather invest in something that's going to make up for my consumption in states that I expect to be bad. An asset that only pays well when I'm already expecting to be consuming a lot isn't worth as much to me, right? I would rather invest in something that's going to sort of make up the gaps in my consumption path. I don't want something that's just going to pile on more when I'm already expecting to have a lot. So this is how the stochastic discount factor is used to value these assets. And one more thing, we can divide through by P naught here. So we can get 1 is equal to the expected value of M1 times P1 plus D1 over P naught, or I can also write this as the expected value of M1 times the return R1. Using capital R for the return just means that we're not subtracting 1. So This equation is called the pricing kernel, and we're going to use this a lot because we'll see that a similar sort of equation is going to show up in other variations of this model. What it's saying is that the expected discounted, and remember the discount factor here is itself a random variable, the discounted return, expected discounted return is always going to be equal to 1. So we had a variation of the problem with just a single asset, but of course, that's not that useful because when we're trying to set up an asset pricing model, we need to think about a model where we can build a portfolio of a bunch of different assets. So I'm going to have the same problem. I'm going to maximize my 2-period utility, but rather than C naught just depending on my investments in one asset, I'm going to allow myself to invest in a bunch of different assets. So PI naught is the price of asset I, and SI is going to be how many shares I buy in asset I, which means that my future payoff is going to be PI1, that's the future price of asset I, plus DI1, that's the dividend, times the number of shares. And so both of these are summed from I equals 1 to n, which means I have n different assets that I can invest in. So we're going to maximize your 2-period utility with respect to SI for each asset. Now, the optimization is actually pretty simple because these terms are just additive. So we have a first order condition for each stock, which is that U prime of C naught times the price of stock I today is equal to the expected value delta U prime of C1 times the future payoff of stock I, so PI1 plus DI1. If we have this expression, well, we can just divide through. What do we get? We get 1 is equal to the expected value of delta U prime of C1 over U prime of C naught. What's that? That's our stochastic discount factor times PI1 plus DI1 over PI naught. And what's that? That's the return. So what we have is this pricing kernel, and it doesn't matter how many assets we have in the model. For every asset, the expected value of the discounted return has to equal 1. And so the important thing to recognize here is that while the return is going to be a different thing for each asset, the stochastic discount factor is not indexed by I. So your stochastic discount factor is going to be the same for every stock that you could potentially invest in. Now, this is a little bit confusing because we've been talking about this idea that, well, depending on how risky a particular asset is, we need to think about using different discount rates, right? That a more risky stock warrants a higher discount rate. But now we're talking about using a stochastic discount factor, a discount factor that we're going to apply equally to every stock, regardless of how risky it is. We can imagine that some of these assets are very risky and some are not. So what's going on here? Doesn't this contradict what we've been saying before? Well, the answer to that is no. This is not a contradiction of what we've been saying already, because what we have is we have a discount factor that goes inside the expectation. So this is different than saying, okay, well, I'm going to say, for example, set the price equal to the expected future payoff divided by 1 plus some fixed discount rate. Here we're putting the discount factor inside the expectation operator because that discount factor is going to be stochastic. And so we can think about how this can change our understanding of how asset pricing works. So let's imagine we just had two assets in the model. We had a risk-free asset and a risky asset. And so for both of these, we can apply the pricing kernel. So E of M times RF is 1. E of M times RE is also going to be equal to 1. Now, with a risk-free asset, R is going to be a constant. So what we can do is we can bring that term outside the expectation so that we can say the risk-free rate is 1 over the expected value of the stochastic discount factor. What can we do about the risky asset? If you guys remember, expectation of a product is not the same as the product of the expectations. So I'm not able to just split these two terms. This term doesn't allow me to so easily solve for the expected return to the risky asset. There's some more steps I have to do to get that. Now, if you remember, when we're talking about CAPM, CAPM says that the return to any particular stock depends on its covariance with the market, right? The covariance with the market determines beta, and beta determines the amount of risk premium that the stock is going to pay. Now, here we have kind of the two terms to covariance. And so somehow the return to stock E, to a risky asset, somehow is going to depend on its covariance with something. So let's investigate that. Let's see what's going on there. So we really have to focus on the stochastic discount factor here, okay? So we said that the stochastic discount factor tells you how much you value consumption in each future state, and that the consumption is random because it depends on your investment performance. Therefore, the discount factor is also going to be random. So let's imagine that your consumption today is 200, and that your consumption in the future is random. And there's two possible states. So you can either have state L and you can have state H. And in both of these states are going to happen with probability 0.5. So in state L, your consumption stays at 200. In state H, your consumption goes up to 400. So what can we see here? Well, state H, we're going to be better off. So how is that going to drive our investment decisions? Well, let's imagine we had two stocks. We had A and B. The price of A is going to be 8 in state L and 4 in state H. And the price of stock B is going to be 4 in L and 8 in state H. So stock A is going to pay better in state L, and stock B is going to pay better in state H. So which of these stocks looks more attractive to us? Well, if we think about the priorities of a risk-averse consumer, I would want to invest in something that's going to bring my consumption in these two states closer together, right? I don't really want to invest in stock B because stock B is just going to pile on more when I'm already doing well, right? When I compute the stochastic discount factor, that'll show that I don't value consumption in state H as much as I value consumption in state L. I would prefer to invest in a stock that's going to make up for this shortfall. I don't want to invest in something that's going to make it worse. So let's just For the sake of simplicity, let our rate of time preference equals 1. And then let's say that I have log utility. So we said that the stochastic discount factor was going to be delta u prime of C1 over u prime of C naught. Here, delta is equal to 1. U prime is 1 over C. So our stochastic discount factor is going to be C naught over C1. So this illustrates pretty clearly, if I have a risk-averse consumer, the more I consume in the future, the less it's going to be worth to me. So my stochastic discount factor in state L is going to be 1, and my stochastic discount factor in state H is going to be 1/2. So let's think about the ramifications that this has for asset pricing. Well, we said that P naught was going to be the expected value of M1 times P1 for each stock. So what's M1 times PA? Well, in state L, that stays at H because M is just 1. But in state H, this goes down to 2. Because I don't value that payoff in state H as much. What about for stock B? The 4 stays, this 8 turns into 4. So what's the price of stock A today? It's going to be the expected value of M1 times PA1. The expected value of M1 times PA1, because these states are equally likely, is going to be 5. And if I do the same computation for stock B, I'm going to get that stock B is only worth 4. So these asset prices are exactly going to encapsulate what we talked about, right? This idea that because I'm risk averse, I care more about payoffs in a state where my consumption is going to be low. So an asset that pays well in state L is going to be worth more. And we can see by computing the asset prices that this is indeed going to be the case, right? Stock A is better because it pays me more when I need it to. So even though these two stocks have the exact same degree of risk associated with their future payoffs, we can see that stock A is going to be worth more. And as a result, if I then compute the expected return, so the expected return to stock A is going to be the expected value of the future price divided by the price today. The expected value of the future price is going to be 6, and the price today is 5. I get that the return to stock A is expected to be about 20%. Whereas if I do the same calculation for B, well, the expected future price for B is also going to be 6, but B is only costing 4 today, so the expected return to B is about 50%. So we can see once again, B is a less desirable asset because it doesn't pay me when I need it to. Therefore, it costs less and it must promise a higher return in order to get me to invest in it. So when we were talking about the portfolio choice model, we were talking about these different risk factors that need to be priced in. So here we also have a pertinent risk factor. Right? The risk factor here is not so much the market risk factor, but rather the consumption risk factor. What investors are dealing with is the fact that their future consumption is going to be random because it's based on the performance of their investments. And that's going to inform what types of stocks they prefer. A stock like stock A, which pays better when your consumption is expected to be low, is more valuable because it's paying you exactly when you need it to. Therefore, it's going to have a higher price. So we have this notion, therefore, that the price of an asset depends on how much its return is going to covary with the stochastic discount factor. So the stochastic discount factor is going to tell you exactly how much each state of the world is going to be worth to you in terms of how much additional consumption in that state is going to be worth. So the covariance is equal to the expected value of M1 times RA1. So what is this? Well, this is the pricing kernel, right? This is always going to be equal to 1 minus the expected value of M1. So remember, M1 was either going to be a half or 1 times the expected value of RA1. So the expected return to stock A, well, the price of stock A today was going to be 5, and the price in the future was either going to be 8 or 4. So if we compute the covariance, stock A has a positive covariance with the stochastic discount factor, whereas stock B, because it pays more in state H, has a negative covariance with the stochastic discount factor. So assets that positively covary with the stochastic discount factor are going to be worth more, right? Because they pay more when you need them to. Okay, so that result is all well and good, but if you recall, that is just a solution that we get to a two-period model. Now, a two-period model is not really that plausible, right? Because what I'm doing is I'm investing some amount today, and then the next period I sell everything, consume that, and that's the end. That's not really that realistic. What we really want to think about is someone who is investing some amount today, and possibly the next period they're going to sell some of it, they're going to withdraw some, but they're also going to roll over some of their investments and possibly invest more. So they're carrying their investments forward across multiple periods. This is a more realistic model of how people invest. And in fact, because we don't really know how long we're going to live for, we can't plan our investments just for a finite horizon, right? So we really need to think about an infinite horizon problem. So we're going to let t be the time today, and we're going to let tau be the variable that we use to count it. So we have t plus 1, t plus 2, all the way to infinity. And so we need to think about the utility of consumption in period tau for each tau starting from today all the way to infinity. Now, we have to think about the principle that the farther off in the future that payoff comes, the less it's going to be worth to me. So the rate of time preference is going to be taken to the power tau minus t. So the further off in the future that future period is, the less I care about it. And because my future consumption is random, I have to take the expectation. And specifically, I can say I can take the expectation conditional on the information I have today. So ET basically says, given what I know today, what's my expected value of my utility in period tau? And then I'm going to sum up all of these guys from tau is equal to t all the way to infinity. And I'm going to maximize that. So this is the expected utility of my entire future consumption path. Of course, I also need to think about what constraints I put on it. So let's imagine that in this model, I start with some amount of wealth, A t. So A tau is going to be how much wealth I have at the beginning of period tau. So my consumption in each period is equal to my starting wealth minus the number of shares I buy times the price of this asset in period tau. So for now, we just have a single asset, but as you have seen before, modifying the model to account for multiple stocks is not that difficult. So S tau is how many shares I hold in period tau. And how many shares I hold in period tau is going to determine my wealth next period. And then from whatever wealth I have next period, I can choose how many shares I want to hold in period tau plus 1. That's going to determine my consumption in period tau plus 1 and how much wealth I'm going to have in period tau plus 2. So what I'm doing is I'm choosing a sequence S tau from tau equals t to infinity. I'm planning out how many shares I'm going to hold at each period in the future to maximize the expected value of my entire consumption path. Okay, so the problem that I just laid out seems kind of mind-blowingly complicated, right? I am going to try and plan out my entire future to maximize my expected utility. That seems like a pretty big ask. So this seems like a very difficult problem to solve because I need to balance my consumption and saving, not just across 2 periods, but across an infinite horizon. So this seems like a much more complicated problem to solve than what we dealt with the 2-period problem. So one neat thing about this particular problem is that we can define it recursively. That's going to give us a nice little clever way to solve it. Okay, so we're going to write our objective function again. And for any optimization problem, the maximized value of the objective function is going to be called the value function. And what's the value function going to be a function of? Well, C, the consumption path, depends on how many shares you buy, right? The number of shares you buy and hold in each period is going to be your consumption, is going to determine your consumption. So the only exogenous variable that we're starting with here is AT. That's going to be your starting wealth. How much wealth you start with is going to determine how you can allocate your investments throughout this entire period, throughout this entire infinite horizon, in fact. So what we can do is we can take this sum and we'll pull out the first period. So U of CT plus the sum from tau equals t plus 1 of ET delta tau minus t U of C tau. So I just pulled out the first term. Well, what you can see is that this looks a lot like this, right? So what I can do is I can say, okay, well, conceptually, this idea that I'm planning out my investments over an infinite horizon to maximize my utility of my entire consumption path, that's really complicated, right? So let's think about a slightly different approach. I'm going to choose not an entire path of investments, but I'm just going to choose how much I'm investing today. And my investments are going to be a trade-off between current consumption, okay, and not necessarily future consumption, but rather future wealth. V of AT plus 1. So I've defined V recursively. What does that mean? If you give me this much money, AT, I have a choice between consuming today and leaving myself wealth in the future. Because I have this delta VAT plus 1 here, that means I'm saying whatever money I leave myself in the future, I'm going to trust that my future self is going to optimize and utilize that wealth the best way that I can. So rather than thinking about an entire infinite horizon, basically what I've done by defining the problem recursively is that I am now thinking about an infinite horizon problem just like a two-period problem. I'm thinking about the trade-off between the consumption today and my expected future value. So my investment decision is a trade-off between CT and AT plus 1. Right? Because you remember, CT was equal to AT minus ST times PT, and AT plus 1 was equal to ST times PT plus 1 plus DT plus 1. So the more that I invest today, the less I can consume today, but the more I'm going to leave myself in the future. And then for any period after today, I'll let my future self worry about that. I'm going to trust that my future self is going to optimize with whatever wealth that I leave myself. We're going to have very similar first order conditions that we're used to. We're going to have u prime of CT times d CT dST plus the expected value of delta V prime of AT plus 1 times dAT plus 1 dST. dCT dST is minus PT. And this is PT plus 1 plus DT plus 1. So we have this condition that looks very similar to the first order condition we had in the two-period problem, except instead of the marginal utility of future consumption, we have the marginal value of future wealth. All right, so this creates a little bit of a complication here because, well, we know what U is. We defined what U is, and so we can calculate marginal utility very easily. Well, what's this thing? What's V prime of AT plus 1? Remember how we defined V. V was defined as the maximum of U plus the expected value of delta VAT plus 1. So we defined V recursively, which means that we don't actually know what its functional form is yet, right? What is V? We don't know that yet. We have to solve the problem because we defined value in terms of itself. So if we don't know the functional form of V, how do we know what to take the derivative of? What are we going to do about this? This seems like we're stuck here. So in order to get around this, we need to introduce probably one of the most useful theorems that you'll ever encounter in economics, and that's the envelope theorem. So we have something that we're trying to maximize. So we're just going to write all this is equal to CT, plus the expected value of delta V, and we're also going to expand AT plus 1, okay? So and we're going to call this objective function W, and W is going to be a function of AT and ST. And so if W is our objective function, V is going to be defined as the maximized value of the objective function with respect to ST. Okay, so it's important to recognize here the distinction between W and V. W depends both on my starting wealth and the number of shares. So any choice of S is going to tell me a value for this objective function. V is only a function of AT because I am choosing the level of investment that's going to maximize W. Okay, so W depends on both A and S. V only depends on A because I'm choosing S to maximize this objective function. I can also write ST star as being the argmax of W. And basically ST star just tells me how many shares I'm actually buying. So which means I can write V of AT as W of AT, ST star of AT. So I can say that the value function is just the objective function evaluated at the optimum. If I choose the optimal number of shares, then I plug that in for ST here, I'm going to get the value function. All right, so we have V of AT is W evaluated at the optimum. So what's V prime of AT? Well, we can now just take the total derivative of W. All right, so we have V prime of AT. Well, AT, your wealth, is going to influence W in two ways. Right? There's going to be a direct effect. The more wealth you have, that's going to directly make you better off. But there's also going to be an indirect effect, because there's an indirect effect where giving you more wealth is going to change your investment decisions. And then your investment decisions are going to indirectly impact your value. So we can say that increasing AT is going to influence your value both through a direct effect and an indirect effect. So what do we have here? Well, we said that you are maximizing V is W maximized with respect to ST, right? So that the partial derivative dW ds evaluated at S equals S star at the optimum should equal 0. So if we were to evaluate all this stuff at the optimum, this term is going to go to 0. So this is the key result of the envelope theorem. Basically what it's saying is that if I have a function that takes an exogenous and an endogenous variable, and then I consider the optimized value of that function, when I consider the effect of changing the exogenous variable, evaluated at the optimum, I only have to consider the direct effect. The indirect effect is going to go to 0, at least for incremental changes in A. So what does that mean? The v prime of AT is just going to be dw dAt evaluated at the optimum. Well, if you remember what W was, W was the utility, and consumption today was AT minus ST times PT plus the expected delta value of AT plus 1, which was ST times PT plus 1 plus DT plus 1. So if I look at W, AT only appears right here. So what's dW dAt? That's just U prime of AT minus ST, and I'm evaluating the optimum, so ST star of PT, ST star of AT times PT. So that's just equal to U prime of CT plus 1. So what we can see is that when we apply the envelope theorem, we have that V prime of AT is just U prime of CT, which means that V prime of AT plus 1 is just U prime of CT plus 1. So we had this first order condition, which is that U prime of CT was V prime of AT plus 1 times PT plus 1 plus DT plus 1. And we said there was going to be some difficulty in evaluating this because we didn't know what V prime of AT plus 1 was. Well, we know what it is now. The marginal value is just equal to the marginal utility. And then what this now allows us to do is to divide through just like we did before. We divide through by the left-hand side. We get 1 is equal to the expected value of delta U prime of CT plus 1 over U prime of CT times PT plus 1 plus DT plus 1 over PT. So what do we have? We just have the same pricing kernel we did before. MT plus 1 is going to be the stochastic discount factor in period T plus 1. And the second term is going to be the return in period T plus 1. So we end up with the same pricing kernel. E of MT plus 1 times RT plus 1 is equal to 1. So what does that mean? As a result of being able to utilize the envelope theorem, we have the exact same condition as we did in the 2-period problem, which means that all of our intuition from the 2-period results still holds here. Right? So this picture kind of demonstrates how the envelope theorem works. You can think about each of these curves represents W for a different value of A. So we can think about the optimized value of W for each A, and then we can just draw V, the value function, as just connecting the optimal points here. And the envelope theorem just says we don't have to worry about what goes on down here. When we're thinking about the impact of changing A on V, we just have to look at the upper envelope. That's why it's called the envelope theorem. Okay, so what's the intuition here? We have that V prime of AT is equal to u prime of ct, and u prime of ct is going to be equal to E of delta v prime of at plus 1 times rt plus 1. Okay, so the first identity comes from the envelope theorem, and the second equality comes from the first order condition, right? Which is that if I give you $1 today, what can you do? Well, you can either consume it or you can save it. If you save it, you earn RT plus 1 for every dollar that you invest. You're going to have to discount by delta, and V prime of AT plus 1, that represents how much additional value you get per dollar that you earn in returns. So what this equality is saying is that if you are optimizing and I give you $1, you're going to be indifferent between consuming that dollar and investing it. If you were not indifferent, if one of these were higher, then that means that either you're not investing enough or you're investing too much. You're not optimizing. So if you're optimizing, that means that your marginal utility of consumption and your marginal utility of saving have to be the same. And well, if we just keep carrying this forward, right? V prime of AT plus 1 is U prime of CT plus 1. And then we have a similar identity for U prime of CT plus 1, and we can just keep carrying this forward. So at the optimum, you have to be indifferent between consuming an additional dollar and saving an additional dollar. That describes someone who has maximized their value. So if you recall the CAPM, the excess return to a particular asset depended on the beta, right? The beta was how much exposure that stock I had to market risk. And for every unit of exposure you have to market risk, you get an excess return, a risk premium, which just so happens to be the market excess return. More generally, we can think about the arbitrage pricing theory in which you're going to have a number of betas because you're going to have a number of risk factors. BIK is stock I sensitivity to risk factor K. And each risk factor is going to carry a risk premium of gamma. So more generally, each stock has sensitivities to all these different risk factors we might want to consider. And the sensitivity to each risk factor is going to determine the risk premium that stock I carries. Well, those are the risk factors that we're thinking about in the portfolio-based model. What types of risk factors do we care about in the consumption-based model? Well, in a consumption-based model, what do investors care about? They care about consumption, right? They care about asset returns because when asset returns are higher, that means they can consume more. When asset returns are lower, they're not able to consume as much. So the risk factor that they care about is not so much the performance of the market, but growth in consumption. Right? So we're thinking about a consumption risk factor. So let's think about a portfolio that reflects the growth of your consumption. Let's think about a consumption portfolio. Now, what we said is that if I'm thinking about a risk factor, we're thinking about some type of beta, right? Some type of sensitivity to a risk factor. And the sensitivity to a risk factor depends on the covariance of a stock return with the risk factor. Well, Like we talked about before, if I have an asset that pays well when consumption is high, that asset is worse for me, right? Because I want assets that pay well when consumption is low, which means that if I have an asset that has a high consumption beta, it's going to have to offer an additional premium to make me want to buy it. So let's think about the most general version of this multi-period optimization problem that we can think of. So we're going to define the value function recursively, and we're going to maximize subject to the constraint that consumption is equal to wealth minus savings. And we're going to allow you to buy shares in n different assets. And your future wealth is going to depend on the future price, as well as the dividend, of each of these assets. So this is the most general version of this multi-period optimization problem we've had, right? So we have an infinite horizon problem with n different assets. And if you noticed, right, we had the two-period problem, we had the two-period problem with multiple assets, we had the infinite horizon problem with one asset, and all of those ended up having the exact same first-order conditions, basically, the same pricing kernel. So if we have this general version of the model, we have an infinite horizon problem with n different assets, well, what is the first-order condition going to look like here? Well, without belaboring the point too much, we're going to end up with basically the same first-order condition. Your marginal utility times the price today is equal to the expected value of delta times v prime. Well, v prime is just u prime of ct plus 1 times the payoff pit plus 1 plus dit plus 1. So we're going to divide through. We're going to get that 1 is equal to the expected value delta u prime of ct plus 1 over u prime of ct. We know what this is. This is the stochastic discount factor times pi t plus 1 plus dit plus 1 over pt. We know what this thing is too. This is the return to stock I. So we're going to have the same pricing kernel. Expected value of mt plus 1 times ri t plus 1 is equal to 1 for every asset from 1 through n. If I have a risk-free asset, I can bring RF outside the expectation because it's a constant. It's not going to be a random variable. Okay, we have this pricing kernel, which we've seen a bunch of times. And so how are we going to get from something like this to something that looks like a CAPM type equation? Well, if E of mt plus 1 times Ri is equal to 1, and E of mt plus 1 times Rf is equal to 1, that means the expected value of mt plus 1 times the excess return is equal to 0. Now, if you remember what the definition of covariance was, the covariance of x and y was equal to the expected value of x times y minus the expected value of x times the expected value of y. So that means the expected value of x times y is equal to the covariance plus the product of the expectations. So we can do that here. Is equal to the covariance of mt plus 1 with the excess return plus the expected value of mt plus 1 times the expected value of the excess return. So we're pretty close to getting what we're looking for here, right? We know this thing is equal to 0, which means that the expected value of RIT plus 1 minus the risk-free rate is equal to minus this covariance. So the covariance with the stochastic discount factor divided by the expected value of the stochastic discount factor. Well, if I look at this equation tells me what the expected value of the stochastic discount factor is, because RF is a constant, which means I can bring it outside the expectation. So the expected value of MT plus 1 is just 1 over the risk-free rate. So I can simplify this even more. The expected excess return is just going to equal minus the risk-free rate times the covariance with the stochastic discount factor. Okay, so let's just leave off the time subscripts to save space. You have that the excess return is equal to minus the risk-free rate times the covariance with the stochastic discount factor. So we have covariance with something, right? How much the return is exposed to the risk reflected in the stochastic discount factor determines the excess return. Well, remember how we defined risk factors when talking about CAPM and the arbitrage pricing theory? The risk factor should be something that you can invest in. Well, let's define a consumption portfolio, RC, as being a portfolio that matches consumption growth from CT to CT plus 1. So there's some type of portfolio that's going to track the growth in overall consumption. And also, let's assume that you have constant relative risk aversion utility. So your marginal utility is just going to be C to the minus rho. And in this case, what's going to be the stochastic discount factor? Well, it's going to be delta times U prime of CT plus 1 over U prime of CT. If this is U prime, the stochastic discount factor is going to be consumption growth to the power minus rho times delta. Which is going to be delta times RC to the minus rho. Now, we have to do a couple of approximations here, because what we want to do is we want to show that we can turn this term, covariance with M, into something that says covariance with RC. And so we can do a couple of approximations and say that M is approximately equal to delta times 1 plus rho minus delta rho times RC. So we've made some approximations to make M into a linear function of RC, which means I can express the covariance with M in terms of the covariance with RC. Okay, so we have the excess return in terms of the covariance with M, M as a function of RC. And so the covariance of M with RC is going to be the covariance of all this stuff. Okay, well, this is a constant, so that doesn't go into covariance. We just have to worry about minus delta rho RC. Anytime we have a covariance, we're just adding a constant that doesn't contribute to any variation. We can bring this minus delta rho outside. We're going to have minus delta rho times the variance of RC. Now, what about the covariance of M with any portfolio? Covariance of M with Ri. Well, that's going to be the covariance of minus delta rho RC. Once again, we can forget about this term with Ri. So we have minus delta rho covariance of RC with Ri. And so we said that the excess return was going to be minus RF times the covariance with the stochastic discount factor. So if I want to do the expected value of Ri minus Rf, that's going to be equal to minus Rf times the covariance, which is delta times rho of the covariance with Rc. And then if I want to divide this by the expected value of Rc minus Rf, that's going to be equal to Rf times the covariance of M with Rc, which we know is delta rho variance of Rc. So let me write the numerator again, just so it's clearer. So now, hopefully, a very clear picture should have emerged, right? This cancels out, which means that the expected Ri minus Rf is equal to covariance of Ri with Rc divided by the variance of Rc times the excess return to the consumption portfolio. Of course, what is this thing? This is going to be my consumption beta, the extent to which the asset return covaries with the consumption portfolio. So this represents the exposure to consumption risk. So basically, I have an equation that looks exactly like CAPM, except that instead of having the market return and the market beta, I have the return to the consumption portfolio, which reflects the overall rate of consumption growth minus the risk-free rate. So it's exactly like CAPM, except I've replaced the market portfolio with the consumption portfolio, hence the consumption CAPM. So, once again, with the consumption CAPM, we have a single risk factor. That risk factor is consumption risk. I want assets that pay well when consumption is low because those are going to make up for shortfalls in my consumption. Therefore, assets that pay well when consumption is high, assets that are more exposed to consumption risk, need to pay more of a premium in order to get people to invest in them. And so we have a very CAPM looking equation. The beta just represents the exposure to consumption risk, and the risk premium, which just like in the standard CAPM, the risk factor and the risk premium are exactly the same. The risk premium is going to be the excess return to the consumption portfolio. So for every unit of exposure to consumption risk, the asset has to pay an additional risk premium that is equal to the excess return to the consumption portfolio.